Hello friends, this is Priya from Chennai. Today we are going to see accounting concepts and conventions. These are the rules followed in the accounting system of bookkeeping. So let's see what are those rules. Business entity concept, money measurement concept, going concern concept, cost concept. The first thing is the business entity concept. Here business is different and the owner is different. They both are two separate independent entity. Let's take an example. If the owner invests the money in the business as a capital, so that capital should be treated as a liability to the owner. So the business has to repay that liability to the owner. So from this first point, it is clear that the both are different. They both are separate independent entity. The next one is the money measurement concept. Transaction measured in terms of money, we can say it as a money measurement concept. That is, transaction should be entered those transactions only entered in the terms of money. Why? Because for example, the strike by the employee, the working condition of the company or the management should not be entered. Only the transaction which are entered. For example, let's take for a purchase of furniture worth rupees 5,000. That is, it is given in terms of money. That should be recorded. Not the strike by the employee, the working condition of the management should not be recorded. Only the transaction which are in terms of money should be recorded. Okay, let's see next one. Next thing is the going concern concept. Here, business is a going concern and continuing its operations or the activities for the long period. That is, a businessman will start the business with the hope of continuing the business for a long period only, not to quit the business. So we can say it as a going concern concept. So only in balance sheet we are taking the assets at the cost value, that is at the original value we are taking, not at the resale value, or we are not showing the assets in terms of at the realization cost, at the realization value. So going concern concept is a business will be continue for unforeseeable future. Okay, next one, the cost concept. Here the same way as going concern concept, the asset is recorded on the original cost or the purchase price or the acquisition at the time it is acquired. That cost only recorded. So not the valuation of the asset, that is realization value is not recorded. So up to this we can see. Next we will be seeing this one. Stop. Next very important concept is the dual aspect concept. This is the very important concept in the accounting. Here every transaction, the event has a two or a dual effects. Here according to this principle, every transaction must have a two effects should be there. According to this principle, for every debit or for every debit there must be a corresponding or a equivalent credit should be there. And similarly, for every credit there must be a equivalent or a corresponding debit should be there. The same way this dual aspect concept is followed throughout the system of bookkeeping. This concept is very important. This should be followed. So only the business is following this dual aspect concept. That is, the double entry system of bookkeeping is followed. Okay, next one is the periodicity concept, or we can say it as a time interval concept. This is the concept where it is a period during which the business enterprise required to prepare the financial statements in a specified time interval. That is the particular period. That is, accounts are prepared during the particular period. For example, if they are preparing from the March to April, that is 31st April means They have to follow this throughout the year. They have to follow the same way. Similarly, if the business is following 1st Jan to 30th December, means it has to follow this throughout the accounts. They have to follow this. So this is called as the periodicity concept. Next one is the matching concept. Here the revenues are matched with the expenses incurred during that period to earn the revenue. So we can say it as a matching concept. Here the revenues are matched with the expenses. This concept is based on the accrual or the accrual basis. That is, this is also called as a accrual basis of concept. Already we have seen conventions, concepts in the accounting policies. Now we have to see the conventions of the accounting policies. Okay, here convention of consistency, convention of full disclosure, convention of materiality. The three things only we are going to discuss. Convention of consistency. What is convention of consistency? Accounting policies must be followed consistently from one accounting period to the another. That is, they should follow one particular method that should be followed throughout the year and also in the frequent years. That is, coming years also that particular method. That is, we can say it as a custom or the tradition that should be followed from every year. That should be followed every year. For example, for calculating the depreciation, the firm can have the method as diminishing method or straight line method should be followed. Why? Because they can follow one single method. That method should be followed every year. They cannot change, but it does not mean that they cannot change the method. They can change, but whenever they change, it may make the confusion in the firm. So the person who is verifying the documents may get confused. So only we have to follow the particular method throughout the year. This one is the convention of consistency. Next one is the convention of full disclosure. Here, convention of full disclosure means, according to this principle, accounts must be prepared honestly and all material information should be disclosed in the financial statement. The disclosure should be full, fair and adequate so that the users of the financial information can make correct assessment of the financial position of the firm. Here, all the material information should be disclosed. Next thing is the convention of materiality. Convention of materiality means any transactions or the items that are significant, that have the significant impact on the financial statement, that should be recorded. Here, materiality concept means the firm can ignore the small information which does not have any significant impact on the business. This means that the firm must include all other information in its financial statement which is material and significant. The immaterial can be ignored. For example, take a bill dry cleaning service which has the annual revenue of 40,000. It decides to purchase one equipment that is worth of rupees 50,000. So this is the significant event in the company's year, because the investors and the creditors will be definitely want to know about the purchase which affect the annual revenue of the company. So this is the significant event. So this should be included. So why it is included means it affects the balance sheet of the concern. Now we have seen what are the concepts and the convention of the accounting. Next class we will be seeing what are the rules of accounting, that is debit the receiver, credit the giver. That we will be seeing in the next class. Thank you.